The estimate, the expectation, 8.8% was bad, 9.1% worse. Put it into context.
Yeah, 8.8% was the expectation, which, by the way, was higher than the top line number last month. So we were already expecting an acceleration. This came in even hotter than that. It was eye-popping, to say the least. So when you look at sort of some of the gains, some of the biggest contributors, gasoline, which we talk about a lot, nearly 60% higher than a year ago. Food prices 10.4% and shelter 5.6%. So we talk a lot about gas, understandably. That said, the report, it was broad-based. We saw inflation pretty much across the board. And so this is a huge problem for the Fed. We were hoping that maybe the last few months we had peaked. You see a report like this, numbers like this, and it doesn't appear so.
Dylan, help us understand the White House's reaction. President Biden had said that core inflation has come down for the third month in a row, so they think that's a good sign. And then he also said, while today's headline inflation reading is unacceptably high, it's also out of date. Do you understand? What's the interpretation?
Yeah, so I mean, the issue with markets and economies and politicians of all stripes is there is no issue where they are more misaligned, because politicians of any stripe always want to, they don't want to take the actions that are necessary to actually deal with inflation, and no one can blame them, because who wants to take gas prices to 10 and interest rates to 10? And I think no one will ever do that. So this becomes this ritual of words like the president's today, and at the same time privately alarming meetings to the point about the 9% number and the sort of shocking nature of the headline, which really just introduces, people really wanted to think that maybe the Fed will raise rates one more time and then they'll be done, as opposed to having to go all through next year and all this. And so every time you get a piece of significant data like the one that we received today, it reduces the probability that the Federal Reserve stops moving early. And that is not what the president or any politician wants to hear. So the president is trying to almost jawbone the Fed, in a sense, where he's saying, well, yeah, it's a bad headline, but the core inputs are not that bad, and it's a trailing indicator, and you don't have to raise rates that much more. Like, that's kind of the unspoken piece of that, Allison.
Dylan, the markets are down. Dow is down, what, about 200 points? If we have the big board, let's put it up. How much of this is baked in? I mean,
well, so remember,
down 181.
Yeah, well, since this started, we've lost 14 trillion, in many cases 30 or 40% of all global asset values, since, over the last 6 months. So to answer your question, Victor, it's almost all priced in. Like, the financial markets, the bond market and equity markets have already repriced for the expectations of an economic slowdown. Call it a recession, call it not. We'll see however the numbers behave, but the slowdown's a sure thing. It's nice to have oil coming off a little bit, but there was a little bit of hope developing, maybe not even with strong basis. Sorry, I touched the laptop. With strong basis, that the Fed would not have to continue to be aggressive, but in order for that hope or that fantasy or that wish, whether you're a trader or an investor or a politician, to even have a chance to be true, you need numbers like the CPI to come in below expectations, not like they did today. So, Victor, that's why you get a little sell-off today, because you're like, well, so much for the Fed stopping soon. But at the same time, the market's already been destroyed because of the adjustment in the asset on the asset side, and it hasn't even started to play out as it's going to over the next few years in terms of so many things.
And guys, I mean, the Fed and Chairman Powell have been very clear that they are looking for monthly core inflation. I'm sure they would like to see all of the numbers come down, but certainly monthly core inflation starts to decline, and we're not seeing that just yet. This last month, we saw prices increase monthly about 0.7%. So this is problematic for the Fed. And the reason why it creates a lot of concern is because it now means that the Fed will have to do more rather than less to try to tame inflation. And a more aggressive Fed means the likelihood of overdoing it, of overshooting it, of triggering a recession also goes up. And that's the concern.
I mean, let's just pull up what food prices that everybody can relate to. Dylan, hold on one second. So in the past year, food is up 12.2%. But if you break it down, cereal and bread, 13.8, dairy, 13.5, eggs, 33.1. And, Dylan, I mean, obviously the voters in public polling are holding President Biden responsible for that. What is he supposed to do about those?
Well, I mean, the blunt answer to that question is you have to adjust the sanctions. This is not an inflation issue. Everything related to, not everything, with the most, so you have three things. You have a pre-existing reality. For a decade, America and the world had free money. Shocking inflation took this long. Like, we've been on free money since 2009, but it didn't. Pre-existing free money. Then you have supply chain pinches, which have been covered ad nauseum, and you guys know a lot about. And then the final thing you have is the Ukraine invasion, which in and of itself is disruptive to oil and grain. And then you have the additional political strategic decision to use economic sanctions in an effort to try to stop Russia. And the cost of doing that, specifically to Europe and the United States, is higher fuel and fertilizer costs, which are the most acutely felt by farmers, which is why they've stopped growing food in Europe this summer, because they no longer have a profit margin because of food and fuel cost. And it's why Americans are not happy with their president, because the cost of a gallon of gas, and I'm sure the farmers in this country are not happy by that cost. And so if you want to be, you want real politic, I guess they call it, they have to adjust. These sanctions are extremely expensive politically and financially on NATO and the United States. And thus far, they have made Russia stronger. The ruble's at the highest level it's been in 5 years, and Russia's participation in the global markets, oil markets, is higher than it was before the war, which I would say and they're still in Ukraine. So I just think that you have to think about this question after all this time, especially as it relates to fuel and fertilizer, which is not just inflation. Those sanctions are direct. That is the direct cost of those sanctions.
Yeah. I mean, I appreciate you laying out all of the unintended consequences, because they are mind-blowing when you understand that, right?
Well, I think the risk, Allison,
Yeah.
I think the risk, Allison, is
Certainly.
people think that the gas or whatever is inflation, but it's not. It's not there's a different variable there. That's my point.
Yeah.